XRP moving back up, and we just love to see it, knowing that the SEC versus Ripple case is completely over. Now the rate cut rally has begun, and we are going to be decoding this economic data for you here in today's update with a fresh CPI lie. And then we also are going to be following this up with the ETFs going live for XRP in September or October. It's 100% inevitable, and it's going to lead to a lot in the form of inflows into XRP. So stay tuned for the full update. Let's break it down and get started here with our economic data. CPI lie year over year came in below expectations at 2.7%. They thought it was going to be 2.8. So we got a beat there. It's the same as last month. And so CPI year over year did not get worse, didn't really get better, but it's just maintaining, while core CPI year over year did get worse from 2.9% to now 3.1% on the core. So inflation not really getting better, but they're going to be doing a few things to fix that. And we're talking about stripping out some of these things. But before we get to that, check this out, guys. What's interesting is all these people that were freaking out about tariffs are going to cause inflation. All of the things that are leading to the inflation still being hot are not things that are affected by tariffs. Check it out here from Wasteland Capital. It says the funniest thing about today's CPI is that literally everything that's driving inflation is not subject to tariffs. We're talking about shelter being the main culprit. And shelter would come down if the interest rates would come down too, right? More reason for the Fed to cut rates. Medical services, electricity, restaurant meals, airfares, and used cars, all things not affected by tariffs, and those are the main culprits driving inflation higher right now. Meanwhile, apparel, new cars, and stuff is low or deflating. Very interesting to watch. Same thing here from the Kobesi letter. Same thing here. Utility gas inflation 13.8%, car repair inflation 6.5%, hospital services 5.8%, electricity 5.5%, car insurance 5.3%, meat and eggs 5.2%, homeowner inflation 4.1%, food away from home 3.9%, rent inflation 3.5%. You know, a lot of these are just things that are not impacted by inflation at all. They're impacted by rates remaining higher for longer, providing no relief for our real estate market and for the broader debt market, right? For all the folks, and we just covered it in last night's live show, the level of delinquencies is at nearly its highest rates ever, but these are data points that take us back to the great financial crisis, and we're talking about credit card debt, delinquencies, which is past 90 days late. Credit card, auto loans, and student loan. All at levels taking us back to the great financial crisis. In the case of student loans, taking us back to 2020, right before they did the forbearance, forgiveness, pay, think about it later. And now all that's coming due, and now that's being reported on people's credit. So the pain is for real. And this is what I've been saying. The Main Street economy is still feeling it. It's going to take a while to get out of this one. Endgame macro. When the BLS decides to take something big and costly like long-term care insurance out of the CPI, it's probably not just a simple data cleanup. Long-term care premiums have been climbing fast because more people are aging, care costs keep rising, and fewer insurers are willing to take on the risk. That means that prices in this area have been one of the strongest drivers of healthcare inflation. This has nothing to do with tariffs, right? Once it removed from the CPI, those rising costs won't show up in the headline inflation number, which makes inflation look milder than it really is for older Americans. And that matters because CPI affects things like Social Security, cost of living increases, tips payouts, and Medicare adjustments. So taking out a high cost item can lower how much the government has to pay out. The official reason they give is market shifts. And that's technically true, but those shifts are happening because of long-term trends that make long-term care one of the fastest growing expenses people face. Removing it makes the numbers look smoother, but it also hides a warning sign about how hard it's going to be for many Americans to afford care in the years ahead. And I feel so bad because these are people on fixed incomes, and what happens is when that CPI, they adjust they're bringing that down. That's less that they're going to be paying out in Social Security, cost of living, tips, and Medicare adjustments. And I've been pounding the table since 2022 that we've been in a recession, covered up by manipulated data, and the inflation was not going away. The number one thing I said in my recession to-do list was make more money. You got to get more income because inflation's not going away. And God willing, you can make enough income to be able to invest in these hard assets with real utility and limited supply that are going to continue moving higher, just like we titled the video today, XRP Moving Back Up. Now, the new head of the BLS, EJ Antoni, until the jobs numbers are corrected, the BLS should suspend issuing the monthly jobs report, but keep publishing the more accurate, though less timely, quarterly data. So now they're talking about just not even sharing that monthly jobs number. And there is a lot to clean up. But are they going to take it too far? Are they going to do this to cover it up and make their administration look better? Probably. Right? I mean, this is politics. This is government. This is how they operate. And so the thing about this administration with Trump and everything else, there is a lot to clean up. There's a lot of jobs numbers that are being reported of people that maybe aren't supposed to be here. So there is a lot to clean up. We've been talking about the data being fake and manipulated under Biden. And you can tell that I shoot it straight to you guys because I've been calling out Trump in this administration too for, saying that the economy is roaring back. When you decode the data, the devil's in the details. So you can't say that I swing one way or the other. We just shoot it to you straight. And we've been saying that the data's been terrible and it continues to be terrible. And Main Street, you're going to have to pick yourself up here and figure it out because nobody's coming to save you. That's the point and what I've been pounding in since I started making content 4 years ago. Now, President Trump, he's also going to take this opportunity to consider allowing a major lawsuit against Fed Chair Jerome Powell. And I love how this news dropped. He's been dropping news. Every time Jerome Powell comes to speak, every time a big CPI report's going to come out or an interest rate decision, it's like Trump and Bessent and Howard Lutnick, they all have it planned to release some new headline. They go make an appearance. As soon as Powell goes to take the podium and start his speech, President Trump drops something on Truth Social calling him too late Powell and all this stuff. So the theatrics will continue, but nobody's coming to save you. And so that's why we want to get you tapped in with us. We've been developing a real program and a plan showing people how it's done to not only survive, but thrive during the greatest transfer of wealth in world history and make sure that you're on the right side. Not everybody's going to be on the right side of the greatest transfer of wealth in world history, and not enough people talk about that. That term gets thrown out so much now. I don't even really like using it too much, all that much anymore, because everybody and their brother uses it. Oh, it's the greatest transfer of wealth in world history. Yeah, but explain to people how more than half of the people participating in this transfer are going to be on the wrong side. Their assets and what little wealth they have is going to be transferred to those who are coming to take it. You want to see more data on that? 71 large U.S. companies went bankrupt in July, the highest monthly total since the 2020 situation. This follows 66 and 64 filings in June and May. Year to date, there have been 446 large bankruptcies, the most in 15 years. This is already higher than the full year totals for 2021 and 22, when 405 and 373 firms went bankrupt. Industrial and consumer discretionary companies have led the surge with 70 and 61 filings. The pace of bankruptcies is accelerating. Liquidity crisis is here. The longer these interest rates remain higher, it's not just going to be me and you struggling because we can't get lower credit card rates, we can't get lower auto rates, our student loan debt, all these things that are impacted by this, but it's also these bigger businesses as well that are shuttering their doors. And that's why we've been saying, the first thing I said on the recession to-do list was income. And I was telling people back in 2022 to go to your employer directly, go to your boss and ask them how they are prepared to ride out this storm. I was telling people to do that back in 2022. I won't give you financial advice, but I will tell you to go ask your boss, are we going to be around 2 to 3 years from now, boss man? How are we positioned to handle this debt, currency, and liquidity crisis and Main Street economy bleeding out? And if they can't answer a question, you might need to start looking for another job. And you're seeing now the level of bankruptcies is the highest monthly total since 2020. And it looks like there's no relief in sight. I know that the market's expecting the Fed to cut rates in September, but are they actually going to deliver the rate cuts? I still don't think they will. I still think that they want to stick it to Trump. They don't care about Main Street bleeding out. Not a problem for them. Now, speaking of who else is going to be struggling in regards to rates, when the rates do come down, Circle has been a competitor to Ripple, and we've been talking about their business model, which is really predicated on rates remaining higher for longer because they're making so much money off the treasuries that they're backing USDC with. So when rates come down, that revenue is going away. And I'm going to show you here that they're already struggling. They're actually losing money right now. But the stablecoin wars are underway. This is the guy behind Trump's World Liberty Financial Project. Take a listen in on this one.
Unlike our competitor, we have no long-term rev share deal with any of our distribution partner. So while we're only 1/30th the market cap of Circle, we are already far more profitable than they are. Now, that's because Circle and Coinbase made a deal a long time ago that Coinbase gets 60% of the revenue that comes from Circle, regardless of what happens in perpetuity.
Yeah, they're in big trouble. I'm not going to let him finish his statements. I haven't been impressed by World Liberty Financial and this Zach guy. I think that the Trump team, they shouldn't have aligned themselves with this project, but hey, that's neither here nor there. And he is making correct statements about Circle and their struggles. It's a serious problem. Like you said, why would you want to help out Coinbase if you're one of these other exchanges when you could just not have USDC listed? And this is why, Tether continues to remain the number one stablecoin. A lot of these exchanges don't want to push USDC because 50 to 60% of that revenue, top line revenue, just goes straight into Coinbase's pockets. So why would you go help out your competitor when you could just continue using Tether and maybe the new kid on the block, Ripple, with RLUSD, or if you want to use World Liberty Financial, go ahead. But Circle is losing $482 million despite $658 million in revenue and booming stablecoin adoption. So after going public, now we get to see their earnings, and you get to see there definitely is a devil there in the details. In regards to Circle making $658 million in revenue, half that's going to Coinbase directly. Coinbase did a hell of a deal partnering up there with USDC and Circle. And Circle, at the bottom line, is losing $482 million. They're losing just as much as they're bringing in top line revenue, dang near. That's not the case for RLUSD and Ripple, I'll tell you that much. Now, today, Circle is launching a new layer 1 blockchain called ARC. To me, this is an act of desperation. Another way to kind of, continue the pump, you could say, in regards to Circle and their different offerings. And, maybe this will help drive some more revenue for them. With USDC as the gas token and permissioned validator set. But that makes a very important point that I wanted to really highlight here. Counterparty-free tokens are now more differentiated than ever. And he's talking about counterparty-free tokens like XRP. Even Bitcoin is a counterparty-free token, right? And that you can own, trade, use the token without having to rely on a counterparty. In the case of this layer 1 blockchain called ARC, it's a permission validator set from Circle. It's a permission network. And to me, I put out the tweet here this morning. I said, is it just me, or is it way too late in the game to be launching a new layer 1? See, personally, I'm not interested really in any new layer 1s. Unless it's a new way of computing, quantum computing, etc., there will be new layer 1s generated from that, but that's a new way to compute. In regards to basically just permissioned or public, layer 1s, using the blockchain technology that we have now, I don't think that we need any other layer 1s. And maybe that's just me, but I think that this is just another last-ditch effort from Circle to kind of pump up that valuation, pump up that stock before they're going to be losing and struggling as rates inevitably come back down. And think of how much money they're losing now while rates are elevated. When rates come back down, that's going to be a big problem. One, they're going to be struggling to make revenue, and they're going to be even further in the hole. And here we are in 2025, and they're talking about public testnet launches on September to November. I don't know. I mean, you're talking about doing a testnet. We're working on layer 1s like even Ethereum, for crying out loud. You guys know I don't care for Ethereum, but even Ethereum, it, has a decade of track record now. XRP Ledger has over 12 years of track record. Why would I want to be playing around with a testnet in a proof of concept when we already have many layer ones that suffice and you could just build right on top of them? And we're talking about networks that are very cheap to use and completely permissionless, like the XRP Ledger. But back to that point that Vet made, counterparty free tokens are now more differentiated than ever. And that's what this is about. Removing counterparty risk. That's why we hold our silver. That's why you guys hold your gold. That's why I have cash outside of a bank account. It's why I have a little bit of RLUSD, and I will continue to use RLUSD. Even though RLUSD does have a counterparty in the form of Ripple, it's a counterparty that I trust a lot more than anybody else in this space. And then ultimately, we're holding these counterparty-free tokens like XRP and these other good, solid utilities that are completely decentralized, have that track record, and we're not playing around with the testnet or proof of concept this far late in the game. But let's finish off here. Here's the great news, is that XRP is moving back up and Bitcoin dominance is coming back down. Quick look at the charts before we wrap up this episode. The key level to watch here is that 60% on Bitcoin dominance. Once we see that level break, we will enter that true alt season, and XRP is going to lead that. You see, this is when we broke through 60% back here in November, and that's when XRP and the rest of the alts were really flying, okay? And then the Bitcoin dominance has picked back up through the first half of this year. Now we're starting to see it break back down, and we're about to bust through that key level right here. And this is what triggers the alt season. For XRP, we're back up to 321 today, looking fabulous. I'd like to see a close on the daily candle back above 321. And to me, that would signal that we're getting ready for that next move higher. Only 23%, 24% away from my $4 target that should be coming in here shortly, and only 117% away from that $7 target by September 7th. Everything's still perfectly aligned. The structure's looking fantastic. Bitcoin dominance about to break back down, and the market's already expecting rate cuts, and you already know it's inevitable that we get the ETF inflows coming in starting in October. So not only are these, single digit targets of $4 and $7 XRP coming in, I believe that it's inevitable that we see the double digit XRP this cycle as well. And that's just remaining ridiculously conservative, even though some people will tell me there's no way that XRP goes to $10. Hey, that's okay. You guys let me know what you think in the comments down below. Things are looking fantastic over here. Everything's available at ZachRector.com, and I greatly appreciate your support. God bless you all. I am your host, Zach Rector. I really appreciate all of the love and support. If you want to support the channel, just remember that you can start by smashing that thumbs up for me, sharing this content far and wide, and everything else is at my website.